All right. So if you guys aren't familiar with Kyle, Kyle's with CBRE. Like I said, we're going to wait just a minute or two before we let Kyle start to present. But you're going to find Kyle, if you're in our master class and you have access to our Lender Buckets Excel sheet, you're going to find Kyle in our long-term large balance perm product. So Kyle has a lot of connections being part of like one of the biggest appraisers, commercial appraiser networks in the nation, CBRE. They have such a strong track record. They have really good connections. They have the ability to work with larger clients that us smaller loan brokerages simply can't work with on the investor side. So we're talking insurance companies that can lend, even pension funds. You know, these are people who require a plethora of experience. And if you're a newer broker and you don't have the volume that these guys have, you're just not going to have the resources to fund deals through these same kind of companies. So anyways, that's why we have them in the large balance side. Kyle does lend his own money. However, a lot of what they do, again, is going to be brokered. So just keep that in mind. But the idea here is we're piggybacking off of Kyle's business, which is huge. So we're piggybacking off of their really big footprint, their experience to gain some of these investors that we just simply wouldn't be able to bring on, just like I said earlier. So you'll see him in the large balance area. You got all his information here. I do want to dive a little bit deeper on where your edge is today, Kyle. So you see we have a little area that says what edge you have, like reasons why people like to bring deals to you, as well as your biggest hangups, which is kind of important to me if you ask me. But we'll dive further into this. So if you guys are in our masterclass, you have access to the Lender Buckets Excel. This is where you're going to find him in the large balance commercial perm. So I'm going to stop sharing my screen now. And Kyle, I'm going to let you feel free to take the call. Go ahead and give us, if you don't mind, Kyle, give us like a rundown on CBRE, if you don't mind, just kind of like a background for everybody. And we have more people hopping in right now. Just a background on who you guys are. And then we can get into your guys' product matrix and all that. And I'm going to let you share your screen right now so you can share your screen. So if you don't mind, Kyle,
cool.
Feel free, brother. You got the floor.
Yeah, absolutely. So high level, just to answer that first, CBRE, world's largest commercial real estate company, right? We have offices in every major city across the world. I think there's, we're close to 1 million employees. We're everywhere. And we have, it's full service. It's brokerage. You've probably seen signs around town in front of retail buildings, in front of office spaces, just for leasing signs. So we have a leasing team. We have investment sales. We have appraisal, what John mentioned earlier. We have property management. We have a construction management company. And then I sit on the debt and structured finance team. So that's my niche. I sit in San Diego. I'll go ahead and share my screen. But we brand ourselves. When I say we, it's me and my team. There's 4 of us. We brand ourselves as the Southern California debt team. The reason why we call ourselves Southern California is just simply because we sit here. We lend nationally. But the main crux of it, to John's point, is that CBRE, being as large as CBRE is, we have access to a ton of resources, whether that's appraisers, whether that's investment sales folks, whether that's people on the development side, whether that's whatever it is, and we have those resources across the country. I mean, like I said, we are global. I only work in the 50 U.S. states, but to that end, we have capital sources that range from small little local regional banks and credit unions to larger or corporate Wall Street money, to life insurance companies, and then to the government programs through Freddie Mac, Fannie Mae, and HUD as well. So it's a pretty broad reach. And then beyond that, we do have research teams in every single office as well. So wherever the deal is, we can find a local researcher to pull reports for us. We have local appraisers to get market data. So for being in San Diego and sitting in the southwest corner of the U.S., it gives us incredible access to information and to ultimately capital sources to get deals done regarding where the deal is. So the way that we pride ourselves is based on execution first and foremost, and then what we call, I think it's on this next slide, kind of our white glove service. Like I said, there's a team of 4 of us. My partner is up in Newport Beach. I sit in San Diego, and then we have 2 analysts who will take the reins once the deal is signed up, really work with the lender, process it across the finish line, fill out all sorts of documents for the borrowers and just make it as simple and clean of a process as possible. But to talk through execution and the way we get deals done, it is twofold. We do have direct capital and then we do have brokered business. The direct capital is through those government products, right? Which is Freddie and Fannie. That's strictly for stabilized multifamily, 5 units or larger, minimum loan balance of $1 million. And the way that makes us direct lenders in that product or in that space really is that, those are your premium multifamily lending loan programs, right? They're not going to be recourse loans, or they're going to be there's a lot more competitive on rate, on terms than any bank out there, any credit union out there. But you can't access those products, being that they are government backed, just by going to any bank, by going to any broker. You have to have what's called a seller servicer license, right? There's, I think off the top of my head, it's nine groups across the country that have that license. CBRE is the number one. So we've been named the number one seller servicer across the country. And what determines that is simply loan volume. We do more of those loans than any group out there, giving us a lot wider of a market share. And what I mean by seller servicer is we have a license to go underwrite those loans in conjunction with the agencies, Freddie and Fannie. We have an in-house team. So then we will actually fund it on their behalf. And then once the loan closes, the servicing part kicks in, we service it on our books going forward. So right now, on the screen here, you just see what we've done over the last couple of years. It's not up to date.
Kyle, can you give us, if you don't mind me interrupting, brother, can you give us some examples of what those Fannie Freddie loans would look like in comparison to what like a normal credit union or private money lender we would use? I'm right there with you. It's premium rates and it's a large balance multifamily stuff, but can you just give us a couple of examples of what that would look like? So a lot of our guys who are listening, when we get those, high net worth, high quality investors are looking for something other than this hard money stuff. Can you explain to us a little bit more about what those look like so we know what to look for?
Yeah, absolutely. So your typical Fannie or Freddie loan, they're one and the same, just two different entities, but they look and feel similar. The main structure of them is they're all going to be non-recourse, so no personal guarantees. 5, 7, or 10-year fixed rate term up to the borrower. Right now, the 7 and the 10 years are pricing cheaper than the 5, but the 5-year, being shorter term does give a little bit more flexibility. And outside of that, they're all going to have a 30-year. Here's a little highlight of them, but they're all going to have a 30-year amortization. So regardless of the fixed term length, those loan payments are spread out over 30 years. And you can include a number of different ways to structure it. There's options to include interest-only periods in the first, whether it's first 3 years, first 5 years. We can go up into a full term of interest only just to maximize cash flow. And then outside of that, there's a couple of different prepayment structures as well, right? So we can do, yield maintenance prepay is going to give you your cheapest interest rate. It's a little more arduous on that prepay penalty. And then there's different versions of a smaller step down to provide flexibility. So, what really makes them stand out above the rest is a couple things. One, it's non-recourse, right? Banks and credit unions typically will ask for a personal guarantee. Being that it's non-recourse, we don't need tax returns. The underwriting is largely held within the property itself. And the other thing, right now, rates are well inside of any bank option. I priced a deal this morning, with that rate was at 5.5%. All banks today are closer to 6.5 to 7. So that's a big difference, right? And then when you throw in a couple of years of interest only, that really allows for the property to cash flow a lot better. And then the third piece of it, what makes it, a little bit more enticing to investors, is that they're build to suit. So we can build it out how you see fit, whether it's different rate structures, different prepay structures, different, interest only periods, different term lengths. So they're pretty customizable. And then lastly,
how are they underwriting person here, borrower?
Yeah, on the sponsorship side, they're looking for three things. They want a net worth, which is all assets minus all liabilities, to be larger than the loan amount. So if you're pulling out a $2 million loan, you need a net worth over $2 million, right? Liquidity needs to be 9 months worth of debt service. So I can calculate that for you, but we just want to see that in in the form of either cash on hand, stocks, life insurance policies, right? Anything that's halfway accessible can count towards liquidity. And then the last piece is credit score, just a 650 credit score or higher.
Okay. And so that's really easy to attain for a lot of our guys, except for that net worth
Yep.
part. I'm going to tell you, because they like to stretch things out, right?
Sure.
But let's talk about multiple guarantors, or we have a corporation that comes to us. We got a couple of shareholders, maybe a couple of owners or whatever. Can you explain to us how you might factor in a company that's coming in for this loan?
Yeah. And so it's most deals are going to be owned in a single asset LLC. So your company, right? Anyone that is involved in the ownership group, they don't each individually have to hit those thresholds. It would be the ownership group combined that can check those boxes. So if 4 people are buying, a property that's taking out a $3 million loan, not all 4 people need a $3 million net worth. We can have it combined across all 4 to get to that $3 million threshold. So having multiple partners, having a company buy it does help in the sense that it provides just a little bit more strength that we can tap into.
No, absolutely. Okay. And now let's talk about the property types, if you don't mind. Let's get into the categories of property types we're covering. And then also tell me max loan amount here.
Yeah. So property types, 5 units or larger, right? Strictly stabilized multifamily. So when I say stabilized, the way that's defined is 90% occupancy over 90 days. So the reason why is that these loans are underwritten to in-place income, right? The higher the income the property is producing, the higher the loan amount it can support. So if you have a lot of vacancy on the property, you're just not going to get to a loan amount that's going to be appealing. So it needs to be stabilized, needs to be over $1 million in loan amount. The only, there's nuances around if there's a student population or military concentration within the property. There's just different, exceptions that will have to get done. But high level, 5+ units, stabilized multifamily, $1 million minimum, and deal scope, being that it is only for stabilized properties. I saw a question came up about construction. It only applies to acquisitions and refinances, not for construction or bridge, because we need that in place income, right? So
occupancy requirement. You said stabilized. How stabilized?
Yeah, 90% occupied over 90 days.
Woo!
So we need at least 3 months of basically full occupancy.
Gotcha.
And there's exceptions. We can always go in for less, or if we only have it for 1 month instead of 3. And the 3-month rule is by the time we close, right? If it takes 60 days to close a loan, we can start that basically the day that you get that last unit leased up, and then close it once we hit that 3-month threshold. So
gotcha.
There's a little bit of flexibility there.
How about location? Do you guys have standards on locations? Major MSA, or can you go rural?
Anywhere in the U.S., it can go as rural as possible. So the way that these loans are underwritten, I touched on it earlier, is based on in-place income, and how that's derived to a loan amount is a debt cover ratio. For those not familiar with that term, it's just your NOI divided by your debt service or your loan payment. So in the top markets, right, we have a minimum debt cover ratio of a 1.25, meaning our NOI needs to be 1.25 times higher than your annual debt service. When you start to get to more of those tertiary, the secondary markets, that debt cover minimum does go up a little bit. So it needs to be, in smaller markets, the 130, and incredibly small markets, the 1.35. So what that does is basically just constrains leverage a little bit in smaller markets, but keep in mind in smaller markets, you typically have higher cap rates. So it does get offset to a certain extent. But the underwriting is based on a market tier structure.
Yep. And you guys, the only reason they're able to go into those rural markets is because these are agency-backed loans. And part of what the agencies do is stimulate the economy, and they want to be fair to everybody. So that's what's taking place here. Most private money lenders, as you guys already know, don't like tertiary markets. They stay out of tertiary markets completely. But we have government-backed agency money here, which is why they're subsidizing this kind of stuff. So thought I'd bring a little bit of context there.
Yeah, that's a good point, John. And just to piggyback off of that, these loans, being that they are government-backed and they're mission-driven, their mission is to provide workforce housing. So if there is some form of Section 8 or affordable units on the property, that actually allows for us to get interest rate discounts, because that is what's considered mission-driven business. It's accommodating what the agencies are set out to provide, which is workforce housing. So any sort of affordability, any sort of Section 8, which a lot of that is found in secondary markets, actually does yield a lot lower of an interest rate and much more competitive to that end.
Love it. Okay. So where are you getting most of your business, Kyle? Does most of your business come from brokers like us, or does most of your business come direct to CBRE?
Yeah, it's a gambit. I mean, we get a lot direct and a lot from the investment sales teams, right? If they're selling a building and they have a buyer interested in buying it. But we do have what we consider a wholesale program, which is basically coming when you have another mortgage broker, like everyone on this call, bringing in a loan. Just again, it's a product that you can't get direct. So the only way to get it is to go through a firm like CBRE. So we're set up to accommodate outside brokers that are wanting access to this product. So the way we would do it is, sorry, go ahead, John.
I was just going to say, let's talk about your process working with guys like us.
Yeah. So, on the front end, we want you guys to be involved as much or little as you want. I would encourage you guys to be involved throughout the process, just because it's not only a learning experience, but it's a trust thing, right? Your clients trust you, and I want to leverage that, unfortunately, just to keep the process smooth. But yeah, when you guys get a deal, feel free to send it over to me. I just need basic property level financials, a rent roll and a P&L. I can get quotes put together for you in a matter of 24 hours. Once I send those quotes out, you guys review it with your client. Whatever, if you want me to jump on a call with you and them, happy to talk through it in a little bit more detail, answer any questions. And then, once we get an application out, you just treat us as you would a lender, right? You treat us the same as your hard money lenders, as the bank. We would I don't know if you guys saw, but there was some fallout with fraud at one of the firms at Meridian Capital earlier in the year. So because of that, they did create it to where documents do need to come directly from the sponsor just to avoid that. But you guys would still be heavily involved. We would just need to have, some certification saying that the documents are coming from the sponsor. Outside of that, though, it's, again, treat us as the lender. We are acting as the bank in this scenario. And you guys can get paid one of two ways. You either charge your origination fee as you normally would, or what we can do is we can get you paid out of our fee as well. So once the deal were to close, you would get paid directly either from our fee or, again, charge your own, however you see fit. But we'll make sure you're taken care of at deal closing.
And you guys normally charge 1 point on these loans, right, from your end?
We would. Yep, 1%.
Gotcha. So 1 point, and then we can charge how much more?
As much as you want. I mean, if you ask for something ridiculous, it might be a big hurdle, but yeah, you guys ask for what you want, or what we can do too is we can just increase our fee and pay you out of that. Either way, it ends up being the same, just whatever is more amenable to that borrower.
Okay, cool. I'm going to stop the meeting right now and just ask if anybody has any questions right now. I'll open it up to you. I have a couple more myself, but based on what we've gone over so far, does anybody have any deeper questions for Kyle? I'm going to leave it open just for a second.
On the new construction.
No new construction. Sorry, I'm going to jump in real quick. No new construction on this loan, but Kyle can talk about that outside of their direct funding. Go ahead, Kyle.
Yeah. So the other piece of our business is that brokerage platform, which Carlos does allude to construction. So the agency platform, again, strictly stabilized multifamily 5 units or larger, right? Anything outside of that, we can touch. The way we would act is as a broker, where we have access to banks, life insurance companies, credit unions, debt funds. So that platform consists of, I was just checking it this morning, actually. I think we did loans with 380 different capital sources across the country last year. That ranges from small little groups that have a tiny footprint in some corner of the country to groups that are nationally traded on the NASDAQ and Wall Street companies, right? Yep. A lot of these, specifically on that life insurance company bucket, those are correspondent relationships, meaning that similar to the agencies, you do not have access to them unless you go through a correspondent broker, which CBRE has correspondent relationships with 200 plus life companies like that across the country. So again, that just opens you up to being able to get access to more capital sources you otherwise wouldn't have. And Same thing on those correspondents, like on the agency loans, we would service the loans for the clients as well. So that is a one point of contact from start until the loan is paid off 10 years down the road. But construction, Carlos, to answer your question, does fall into this bucket. So any of these, basically anything that doesn't fit stabilized multifamily, whether it's construction or whether it's bridge or any sort of a commercial deal, right? Retail, industrial, office, mobile home parks, whatever it is, we can get done. We would just act as a broker as well. So in that scenario, you guys would ask for your broker fee, we would ask for ours separate, and then the, whatever lender would ask for their origination fee. So
Carlos,
that's where
this is, if you don't mind me interjecting real quick, Kyle. So Carlos, this is where things get sticky, things get heavy, and this is where you should be doing your job. I would say, I know I'm just saying, but this is what we do for a living. What we do is we place those ground up construction, those private money deals where, they need ground up, they need to do the bridge. That's us. If you've run out of sorts and you just cannot place it, I mean, you can think about sending it to Kyle, but I would honestly say that the reason why you cannot place it is probably just because the deal's unfundable. However, like Kyle was saying, he does have resources.
Just asking a question because you gotta ask because you don't never know. Some of these lenders do all sorts of things, and I'm learning that. So you have to ask. You won't know if you don't ask them.
Oh yeah, no, I'm not reprimanding you for your ask, brother. I'm just saying this is where we start stacking. We stack on the origination fees, and it just gets too far into it. If you ask me, I would say like if you just don't want to do the ground up stuff, refer it to Kyle. He'll get you a good referral fee. That's what I would pursue in that case. If you don't want to, if you just given up, it's like, hey man, I don't want to work with this borrower.
I'm doing new construction. I'm just asking. Was just asking a question because you never know what some of these guys do. That's why you got to ask them. So I'm learning that.
Yep, it's the broker side at this point. This is where they start brokering. Yeah. And so how I feel about referral partner fees and broker stacking. So I would just be careful before you go too far into this end. However, they are a top dog in the space and they have the relationships and it is pretty solid, but I would expect a similar thing where they're going to put feelers out there, right, Kyle? You probably put a couple feelers out there, find out what kind of good responses or bad responses you're getting and kind of go from there, I would imagine. But
yeah, process is similar. We get an initial package, underwrite it in-house, and then depending on the deal, it's going to dictate who's going to be the best fit, whether it's, bank, credit union, life company, and just call the appropriate groups. And if it needs more attention than that initial pass, and we'll dig into that B and C list of lenders. But exactly, the process is no different. I think just a little bit wider of a reach. But to John's point, it does start to get a little bit convoluted when you have a lot of cooks in the kitchen and a lot of fees stacking on top of each other. It just, it tends to, you lose a little bit of control. It gets expensive for the borrower. It just makes it a little bit more of a complicated deal. So happy to, no harm in asking. I'm always happy to help, whether it is just pointing you in the right direction or executing on a deal. But I think to John's point, the most efficient execution that I can offer you guys is do that agency product when we are essentially the direct lender.
Yeah.
But there can be a catch-all net, right?
Either agency or just hand the deal off to let them handle the ground these other things. Because the telephone game just never worked when you can't double broker. When you're touching, feeling lenders, it's like, man, you need direct access. That's what I would do in this case. But
and we're always happy to that point, John, to just sign referral fees. We'll make sure you guys aren't cut out of the deal. We're not gonna, we're in the relationship game just like you guys are. So we'll make sure that you're fully taken care of prior to getting engaged. But it typically does work best once we do have just direct communication to the borrower on that end.
Absolutely. Let's talk about pre-approvals really quick on that last program. So we would work with a lot of guys we do the bridge. We handle the bridge. However, some of our bridge lenders want to see a solid exit strategy. Are you guys able to kind of pre-underwrite based on pro formas where we could give some sort of confidence to our bridge lenders that we have a clear exit strategy using one of the Fannie Freddie products?
Yeah, absolutely. If you want to send over your pro forma, happy to size it and tell you where it would shake out in the loan amount. The main thing to just back into is that debt cover ratio, right? I mean, on the pro forma and the takeout, it could be 2 years down the road. It's anyone's best guess what rates are going to be at that point. But I mean, we do a lot of bridge debt on our end as well, just with that same logic of taking it out with the agency loan so we can get 2 deals out of it down the road. And it's something that we model for our clients all the time. I'm doing a deal right now for a client buying it. He needs a bridge loan, and we're modeling the takeout already, even though it's 12 months premature, but just because we don't want to get our clients into a spot where they can't do the refinance. So yeah, absolutely happy to model it for you. Happy to give you feedback on what that takeout could look like. You know, assuming that the rate is the only variable that we can't quite control down the road.
Right. No, that's understandable. And I'm sure we're starting to see some lenders really hedge for that since we got beat to hell a year or two ago.
Yeah, a lot higher stress rates, a lot more conservative underwriting. So it's all part of it.
Yep, for sure. Okay. How about marketing material? So we have those large balance agency loans. Do you guys have any kind of marketing material you can provide us where we can start advertising some of this stuff to our clients?
Yeah, I can send you guys a couple of things. I'm happy to send you this package. It's pretty brief, but I do have more specific material towards those agency programs. You know, it's not branded CBRE at all. It's just Freddie Mac, Fannie Mae. You know, feel free to pass those around. That's just great information, not only for yourselves to understand the program a little bit more detail, but also to share with, you know, potential clients as well.
Yep, absolutely fantastic. Okay, I see in the chat somebody's got a scenario that they might want to run by you. Kyle, you got a couple more minutes? We can maybe run through a scenario really quick.
Yeah, absolutely.
Cool. Hey, Mark, are you still with us, brother? Looks like Eric's got a scenario too. I think Mark dropped off, so he'll probably shoot you that scenario. But Eric, if you want to jump on the line, the mic's open. So feel free to run one by him if you got the address or some of the key notes that you want to share.
Yeah, basically it's a purchase of, it's 2 apartment buildings, 1 complex, 36 units, listed for $2.5 million. They're looking to offer about 2.3. The NOI, everything looks pretty good, but you know, it's just not in my wheelhouse in terms of loan size and all that kind of fun stuff. But I do have rent rolls and NOI calculations. It's just outside of St. Louis. It's on the Illinois side. So it's about, I don't know, it looks like about 10, 15 miles from St. Louis, but it's in Illinois.
Okay. Yeah. Sounds like a home run. If you want to send that over, happy to get you at least initial sizing, but right now I think that price somewhere in the, you know, like I said, high 5s, low 6s.
Yeah, I think that guy would be super stoked about something.
I would
like
give that.
Yeah.
These are the things. Remember what we talked about earlier, Eric? 90% occupancy. So I'd go back to him today.
It's 100%
the guy up,
as of today, as far as I know. I asked him direct. He goes, no, it's 100% occupied.
100% occupied.
Do you know if this is their first deal or do they have experience with multifamily?
They have experience, but I think this is their first big deal. You know what I mean?
Okay. Yeah, it doesn't matter as
chat
long
with
as
him
they
again.
have a deal under their belt that's 5 units or larger. We can make it work.
Yep.
Okay.
And then that
I have your
liquidity.
Yeah, I'll get that information. Yeah, I'll chat with them right after we get off the phone.
Yep. The other thing is that net worth and liquidity. I would start asking for bank statements and your, you know, your asset statements.
Yeah, if you what's easiest is a personal financial statement, just because it's going to break all that down. If you guys need, I can send a template that you can get a borrower to fill out. It's really simple, but that's a real quick check just on net worth and liquidity.
Hey, after this call, Kyle, throw it over and everybody will get it. So that's fine.
Okay.
That's great.
Perfect.
Hey, so would that qualify for the, I guess it would be the small balance Fannie Mae program, it being at only 2.5?
From a high level, yeah, it's over $1 million, and it sounds like from a high level it will. I mean, there's once we get into it, we'll be able to see if there's other nuances, but you know, based on what you just said, that's a perfect fit.
Yep.
Okay. I've got a 7 unit that just came in today too. It's a smaller one, but I'll send it over to you in a bit.
Okay.
Yep.
Yeah, as long as the loan's over $1 million, then we can look at any of those.
Yep.
By the way, plug for Kyle. He always responds like super quick. I mean, you answered a couple questions for me earlier today, so thanks. He gets back
sorry
fast.
we couldn't get that one done. That was a sharp property. I was impressed by that.
Yeah. So, but yeah, I appreciate you getting back quick, and you always have a yes or no really fast.
Absolutely. Don't want to hold you guys up. I think a quick no is just as important as being able to do it.
Yep. Hard to come by in this industry. Very hard to come by as a quick yes or a quick no. There's too many uncertain, too much
Time is all we
smoke in the air.
have, right? No
Yeah.
need to drag it out.
Yeah, no, totally. And you know what this does, guys, is this really gives you a good, like a target for our borrowers to shoot for. You know, if they're changing their strategies and they're not just selling these, they want to stabilize, they want to get into something more permanent. It gives them something to shoot for. So Justin's deal may not have underwritten as it stands, but guess what? His borrowers might come around, get some investors put together, and maybe, I don't know what it was that they didn't qualify for, but you know, just start changing their strategy and hitting the target. You know, it gives them something to shoot for.
Exactly. So yeah, I mean, I'm happy to help. Like I said, as far as getting deals over, I think if you just want to send whatever it is that you have on the deal in an email, and happy to jump on a call if there's legs and talk to it in a little bit more detail, but I can typically screen it pretty quickly just with the documents you guys get over.
Perfect.
About how long does it take to close something like this?
Yeah, good question. So start to finish, you know, it typically takes a day or two just to get quotes put together. Once we have quotes out, you know, it's up to your borrower to pick an option, or we can talk through it and adjust them as you see fit. You know, from there, it's probably another day just to get an application out. And once the application's out, it's 45 to 60 days typically for closing. You move a little faster if needed. It's just a matter of getting third-party reports expedited and making sure the borrower gets everything in on time. That's usually the biggest hang up, honestly, is just
Right.
document collection.
Always.
Yep.
Sorry,
Always. Yeah, we know about that with our Djurjevic file that
Yeah,
we're working
yeah,
right
that's
now, for
true.
sure.
Yeah, hurry up. How come we haven't closed yet? Well, you gotta send me the stuff we asked you for 2 weeks ago. That's why.
Yep.
Yep.
Story
Hurry
of
up
our
and wait,
lives.
right?
Yes, hurry up and wait. That's the term. Gonna get that tattooed on my back at this point because it gets thrown on me so often. But it's all good. We're blessed to have our clients, that's for sure.
Exactly. So yeah, happy to be a resource. You know, I'd love to get a couple done with you guys. So, you know, feel free to reach out at any point. I think you have all my contact information.
Perfect. All right. Well, I think we got all the questions. You know, I have all the questions I've answered. I think everybody's gone through theirs. If anybody has anything else, feel free to interrupt me right now because I'm about to close this out. Okay. Kyle, thank you so much for hopping on, brother. Everybody, you guys are going to get a recording of this video. You're going to see the full breakdown of what they do, what they don't do, pulled right off of our Lender Buckets Excel. So if you're part of our program, you're going to see that. And Kyle, man, we're happy to have you. We'll see you probably in the next month or two for another live. And dude, we appreciate it. We appreciate everything you do over there.
Cool. Yeah, thank you guys.
All right. Take care, Kyle. Take care, everybody. God bless.